Good morning, good afternoon, good evening, wherever you may be. Welcome to Good Measure. My name is David and I'll be your host today. Today, we have Nigel Scott, director at Digital Partners, a design studio that has a history of designing and rolling out digital transformation projects across the financial services and telecom sector. In 2017, he took out an R&D project called Timbles to Accenture's APAC FinTech Lab in Hong Kong. And at that time, Nigel described Timbles as a distributed network of probabilities, and he's here today to talk with us about that. He's also here to talk a bit about cybersecurity and AI. Nigel, thank you for being here with us today. Can you quickly explain to us what that means and where this technology really comes from?
We were developing 20 years ago, we were developing some technology around business intelligence. While the marketplace were building data warehouses, we built, or more specifically, my brother built an in-memory database. Mm-hmm. And what that would do is allow you to basically take information out of core systems like SAP, JD Edwards, Oracle, basically any database system on the market, and then put that into memory, mm-hmm. and then put a reporting layer on top. Now, we use that work inside the Commonwealth Bank as part of their transition into wealth management when they bought Colonial First State. Mm-hmm. And then subsequently, we got involved in a project inside the Department of Defence here in Australia, which was about solving Senate reporting. And essentially what we did was we put that technology in there to solve those issues of operational capability, financial reporting, HR reporting, and that kind of thing. Mm-hmm. Now, as part of that project, we actually took it a step further. Rather than building a single database, we decided to create a massive pointer network of in-memory data, mm-hmm. which is essentially what this next generation system became. And then on top of that, we started playing with using that massive pointer network to create networks of probability. Mm-hmm. And the rationale behind doing that was we could then take information and cross-pollinate it between different organisations. So in the context of, say, defence, that means they could actually pull data out of their suppliers without actually seeing the operational raw data systems, mm-hmm. but they could see the probability of operational capability around those systems. Now, by 2016, I'd flown into New York to talk to the insurance industry, mm-hmm. essentially to get some visibility of the challenges they were facing in terms of what was the most difficult operational risk to price. And uniformly, the information came back that it was cyber risk. So what we did was we turned the technology onto the challenge of building a cyber risk predictive model. Mm-hmm. And this essentially was the model that we took to the Hong Kong FinTech Lab, which essentially we're running.
Mm-hmm. And now, yeah. Oh, sorry. Quickly, just oh wait, no, you can go on. Sorry.
No, it's okay. And essentially, while we were there, Equifax were hacked, and we got an opportunity to show or demonstrate how the system predicted the probability of the Equifax event and the reputational losses and all the other things associated with that event. And it was that point where a number of the global FSIs turned around and said, what you should be doing is building a hedge fund, not an insurance model. And that's essentially what we've been doing with the technology subsequently.
So after the FSI lab, you tried to explore new markets, or did you try to explore new markets, or did you try to stay within the insurance market with this technology?
I spent a year traveling the globe, talking to people like Lloyd's, Munich Re, Ping An. Basically most of the major reinsurers, to try and get a handle on whether this thing actually had a place within the insurance mm-hmm. sector. What we found was our models were very, very different from the historical models and techniques that the insurance industry were using. Mm-hmm. And so to gain adoption of those ideas would have taken a significant investment in education drag the industry across with us. And so we made the decision at that point that it was actually probably easier to pursue what the FSIs suggested, which was point the contagion and emergent models at hedge fund challenges, as opposed to trying to convince data scientists within the insurance sector that, hey, perhaps what they were doing was fundamentally flawed because cyber risk was a contagion risk as opposed to, say, driving a car or owning a house, where historically insurance has modelled those things based on claims data. If you know how the insurance industry works, when they model life insurance or health insurance or car insurance, they tend to use parameters and then use those parameters to cross-pollinate with the existing claims data to then price the cost of the insurance. And essentially, insurance historically has always been a game of trying to sell policies to those who will never make a claim and make sure those who would be making claims are not longer in the pool, because that's when you start to have to pay out. So yeah.
And so what exactly makes Timbles so appealing to government and securities agents? There must be so much other cybersecurity products. And is it the speed at which Timble can forecast cyber risks, or is it the system that Timbles has in place that uses probability to determine systematic risk?
The key advantage we had was we used the probabilistic models to forecast risk based on a very narrow set of criteria. And that was because the models emerged out of financial, or the office of the CFO. The basic assumption of these models was very simply this, and that is, if you're spending money here but not spending money over there, then basically I can model operational risk based on where you're spending the money, under the assumption that where you're actually allocating resources and budget is a fairly good indicator of your understanding of your risk and the efforts you're taking to actually offset that risk. The key differentiator between cyber risk and a lot of other operational risk is it's actually shared across the value chain. And this is what makes it difficult. Because if you're a major bank and let's say you spend $100 per record protecting that record, and then you transfer that record to a rating agency who maybe only makes $3 per record in total. So one must assume that perhaps they're spending 30 cents in the dollar protecting that record. And it's self-evident that the risk actually isn't within the financial services organisation, because they're doing everything they possibly can to protect that record. The risk actually sits over here in the ratings company, because they're only spending a fraction of the dollar trying to protect that record. And that goes even further downstream if that ratings agency is working with other startups who, again, are spending less and less on actually keeping the records at risk. And so essentially the challenge of cyber risk within the context of those data breaches was simply this, and that is the efforts that FSIs go to actually cut their costs of operations by outsourcing to third-party vendors was actually the point where they're increasing their operational cyber risk. Now, ransomware was actually a very different category altogether, to the point where what we found was, over the period that we looked at the data, it was increasing. We found it was actually far easier to predict the future pricing of Bitcoin based on ransomware activity. And again, this is one of the reasons that the banks was more interested in pushing this thing towards hedge funds than insurance. We found the randomized risk of ransomware was such that it was actually very hard to predict. And more importantly, as most cybersecurity experts would say today, it's increasingly difficult to defend against And it comes down more to your capability to restore operations once the attack's happened. So if you think it in terms of traditional defence language and culture, the real challenge of cyber risk today within the context of ransomware is not so much if you maybe encounter this problem, it's more a case of what's your response going to be when you do encounter this problem, because the probability is so high that it's almost inevitable. So it becomes very much a, some of the best models I have seen in recent times around this tend to be more about vendors offering offensive capability. They actually go in to actively create war games. And by doing those war games, they improve the operational capability of the organisation to protect itself against those offensive operations, which is obviously a very different scenario to taking out insurance and then trying to recover the costs once the event's happened.
Blockchain has been and is being used to help provide greater security for companies through strong encryption, data storage, and I believe integrity. And so, and sometimes even an elimination of passcodes, if I'm correct. And I understand that Timbals has actually been using blockchain in order to create probability networks for companies to use and assess risk. How exactly is blockchain being used to measure and monitor capital at risk?
The blockchain stuff we've been looking at is largely experimental. And so I wouldn't say it's core to what we do. It's kind of the reason we look at blockchain is basically to say, look, we have this existing technology which was about sucking data into memory and then creating massive pointer networks from it. Does blockchain offer a competitive advantage above that? Now, the reality is what the system we originally built was about was speed and agility. Blockchain actually is neither of those things. It's neither fast and it's neither agile. And so it's actually 180 degrees to where we think. We actually undertake those activities simply to test our thinking around our existing model. That's not to say the blockchain has its uses. Increasingly, the amount of activity in that space will mean that interesting things will emerge. But essentially, we always went out there to try and build a Ferrari or a Lamborghini of business intelligence. And we don't see we see blockchain more as, dare I say, the equivalent of a container ship versus a Ferrari. It's industrial strength. It's what its purpose is for. Is a very different set of purposes to what we set out to build 20 years ago. Yeah.
And so when thinking about priorities for a company and their cybersecurity importance, is there a sort of, let's say, like tier list or ladder in which, let's say, security is number one, scalability is number two, and sort of a cost-effective service is number three for a company? And would it be different in your eyes for like a sort of massive company such as Google and with a startup, let's say?
The key to understanding, up until recently, the key to understanding the cyber risk was to understand that certain sectors had significantly higher risk exposure than others. So obviously somebody running a farm had less risk than a Google or a startup which was working in the data space. And it came down to the quality of the records they were keeping and the interest that the hackers would have in those records if they got their hands on them. So it was fairly easy to model cyber risk based on the utility of the record in question. Ransomware kind of changed all that, because ransomware said that so long as people are using software, computers, hardware for anything, if you can get in there and interfere with that, then you can stop them operationally doing business. Therefore, there's a cost, and therefore people are willing to pay that ransom to move away quickly from that problem. And that's why it's become a much more random concern, because as we found with the large shipping companies and the energy companies which have been hacked, before they really wouldn't have been that much of interest to hackers, because their data records, for whatever reason, wouldn't have been as valuable as, say, a Google or a bank. Ransomware, because of Bitcoin and cryptocurrencies, has actually become a far more lucrative field. Having said that, I mean, I forecast the future value of blockchain back in about 2014. And I did it very simply by saying, look, the use case for Bitcoin is organised crime. If we look at the very early days of Bitcoin, most of that activity was Silk Road. It was about organised crime, using it as a trading platform, as a trading tool. And there, if I take that value and I extend it, then I can make a fairly confident estimate of what that value is going forward. And to date, that model, which I built in 2014, has actually held up pretty well. It's pretty much where I said it was going to be based on that activity. Having said that, and when ransomware came along, I included that in the model, and it obviously allowed the model greater bandwidth and projected a much rosier future for Bitcoin. My hesitation in terms of organised crime around ransomware was simply a case of, why would they do that? When the value, the lucrative nature of ad tech and ad fraud was so high, why would they take the easy money which was to be made in ad fraud and then moved across into ransomware, given that the ad tech by and large is not monitored? We rarely see anybody being convicted of ad fraud, yet ransomware is something which law enforcement actively pursue and actively try to close down. What I didn't anticipate was state actors actually using ransomware as a way to fund large-scale R&D activities, as we saw with North Korea and other jurisdictions. So yeah, it was interesting. And the other interesting thing about the arrival of blockchain and Bitcoin, obviously, was that some of the VCs who heavily invested in crypto 7 to 8 years ago, simultaneously heavily invested in cybersecurity. So they obviously had an inkling that where the market use case was for this technology, and put bets on both sides of the table. So yeah.
And so last question. And so on the Timble's website, it says that the key to success is identifying emergent trends and leveraging them to your advantage. There have been many opinions these days I've seen on LinkedIn, YouTube, Twitter, Facebook, all that, about Web3. What are your thoughts about that? I've heard many opposing views and many views going for this new technology.
I think that the most interesting thing about the Web3 is where the story came from. I see Web3 as a narrative which emerged out of Silicon Valley within a select group of investors and venture capitalists who've actually used that narrative to essentially improve the prospects of their portfolio. Up until 2 years ago, there was an awful lot of crypto portfolios that weren't performing particularly well. Fast forward 2 years and those things look like exceptional bets in retrospect. The key to understanding how that valuation multiplied so significantly is to understand that the Web3 narrative actually drove a whole new understanding of the value of that technology, and therefore drove the underlying value of those startups, whether they're exchanges or whether they're tokens or or whatever part of they are in the value chain. And so if anybody's really interested in understanding Web3, I wouldn't be looking at what the commentators are talking about. I'd be going to have a look at the portfolios of venture capital companies in Silicon Valley, and then taking their investments, mapping them to a value chain and saying, okay, if they own this, this, and this, and this, and this, and they're promoting Web3 as that, let's see what the impact is on their portfolio.
Okay.
And in the end, if we follow the money, we see who really wins through the Web3 narrative.
Yeah. All right. Well, thank you for having such a thoughtful conversation with me. And that's it. Do you have anything you would like to shout out? Anything? Would you like to even promote your own podcast?
Yeah. I've recently started a podcast series called Wealthy Tiger, which is probably, it's an iteration of a blog I used to run 10 years ago called Exabyte, which was essentially a blog about money and technology and these things. A Wealthy Tiger is just a chance to talk to a lot of people I met while I was writing that thing over the years. It's another experiment. It's an interesting one. I have a little bit of fun putting these things together on a weekly basis. And you get to meet interesting people. So, it's good fun.
All right. Well, thank you so much.
Yep, thank you.